Let's talk about the internal control procedures. These are procedures that companies put in place to make sure that the objectives of internal controls are met. If you remember, we talked about the 5 objectives of internal controls. These are the procedures that they implement to make sure that these objectives are met. The first procedure is smart hiring practices. That includes interviewing somebody and then checking references, checking credit reports, doing background checks, and conducting drug tests on new employees. Not only is it important to do those background checks and drug tests, but once you hire an employee, you need to make sure that the employee has the proper training and supervision. Companies also need to make clear what the employee's job responsibilities should be. A lot of times, job responsibilities are in writing so that the employee knows exactly what is required of their job. Another thing that companies need to make sure is that they're paying competitive salaries. You need to make sure that employees are compensated fairly for their job and their qualifications. The second procedure that companies have in place is called separation of duties. Sometimes it's also called segregation of duties. This is where you make sure that one person does not do all the transactions, does not handle the transaction from the beginning to its end. In a company, asset handling, record keeping, and transaction approval should be separated. It should be 3 different areas or 3 different people who need to do these 3 duties. Let's take a look at an example. As you all know, accounts receivable represents amounts that are owed by customers to the company. Whenever customers pay on account, they send in money to the company. If the person who records the transaction also handles money, that person could steal the checks and cover up the theft by falsifying accounting records. Because of that, one of the most important control procedures that companies have is separation of duties. We need to make sure that there are different people that handle the assets, keep records, and approve transactions. The next control procedure is comparison and compliance monitoring. This deals with performing reconciliations, which we'll talk about later, performing audits, specifically internal audits, and manual or computer checks. Somebody will physically check somebody else's work, and there are computer checks that are built into the systems that do comparison and compliance monitoring. Continuing with the internal control procedures, companies need to make sure they have adequate records for all the transactions. These include things like sales invoices, shipping records, customer advices, purchase orders, vendor invoices, receiving reports, and canceled and paid checks. All these documents are usually pre-numbered to make sure that we have complete records. So if something's missing, that draws attention. And the pre-numbered documents also prevent theft and inefficiency. Another control procedure is limited access. Companies need to make sure that access is limited to people who need access or who should have access. Typically, assets are handled by custodians. So if there's a warehouse, there's a custodian over the warehouse, and only that custodian can let somebody enter or exit as provided they have the proper authorization. You don't want to let people who do day-to-day accounting have access to those assets. On the other hand, records should be kept by the accounting department. You don't want people who have access to the assets have access to accounting records, because then they can falsify those records. So this limited access goes hand in hand with separation of duties. The last internal control procedure is proper approvals. Companies need to make sure that depending on the level of transactions, there has to be appropriate approvals. For example, if a manager needs to purchase something, he should be given a level of approval, let's say $10,000. If the manager wants to purchase something that is more than $10,000, he would need to get approval from a higher level of management. Your book and PowerPoints have a mnemonic for you to remember the internal control procedures. It's SCALP, which stands for Smart Hiring Practices and Segregation of Duties, Comparison and Compliance Monitoring, Adequate Records, Limited Access, and Proper Approvals. One of the most important internal control procedures is segregation of duties. In addition to internal control procedures, companies have what we call safeguard controls. These 6 items are examples of safeguard controls. A lot of companies have fireproof walls to protect cash and important documentation. For example, I'm sure Coca-Cola's secret recipe is lying somewhere in a fireproof vault. Companies have security cameras. You've seen them all over the place. NCTC has them. You've seen them at Walmart. Lots of places use security cameras as a control. Many businesses purchase fidelity bonds on people who handle a lot of cash. A fidelity bond is an insurance policy that reimburses the company for any losses due to employee theft. Before issuing a fidelity bond on an employee, the insurance company does an investigation of the employee's background. Things like credit checks, just to make sure that that employee has less likelihood of stealing from the company. Mandatory vacations. This is where companies require employees to go on vacation so they can have another employee do that person's work for a short period of time. If an employee knows that somebody else will be looking over their work, they're less likely to commit fraud because it could get caught. Some companies hire loss prevention specialists. These people train employees to spot suspicious activity. So your employees are trained to study body language or to notice the signs when somebody might be committing theft. Finally, some companies perform job rotation. That's kind of similar to mandatory vacations, goes hand in hand. Each person does a different job, maybe, every 2 months or 3 months, so that every person in the office gets training on every single task. What this does, it lets everybody see everybody else's work. So this minimizes fraud as well as improves job training. So if one person leaves, you're not left with somebody who does not know how to do the job. Everybody in the office knows how to do everybody else's work. Now, a company could have the most perfect internal control system. However, there are ways that a good internal control system can be circumvented. The word circumvented means bypassed. These 3 things are the means by which a good internal control system can be circumvented. The first thing is collusion. Collusion is a term we use when 2 or more employees get together to commit fraud. Remember how we said that separation of duties was the most important internal control procedure? If there's collusion, it doesn't matter if you separate the duties. These people get together to commit fraud. Another way that internal control can be circumvented is by management override. You may have the most perfect internal control system in place, but if manager says, forget what the rules say, just do it this way, then you run the risk of fraud being committed because now you've let somebody override the internal control system. The third way is fatigue and negligence. If your workforce is overworked, there are human limitations and internal controls will get bypassed. One thing about your system of internal controls, the stricter the internal control, the more it costs. So every control you implement has to pass the cost-benefit test. In other words, any benefits that you gain from implementing an internal control should outweigh the cost of implementing it.